Okay, here we are again. It's Monday. So let's see. Now we have a couple of fun videos today, and then we'll get back to where we were. We were discussing hedging risk with derivative securities. Hold on one second. Oh, yeah. I don't know anything about that. If you guys set up something like that, that's fine. I'm the worst person to ask about something like that because I didn't even know there was such a thing as an Instagram group chat. Um, I thought Instagram was just pictures. What is that? They do chats too, huh? Wow.
Yeah, you can message people. I forgot to like throw in my name at the beginning of the
No
semester.
kidding. Wow.
So if anyone
Yeah,
wants to add me, I'm just gonna throw it in. Sure. Okay. Thank you, Jake.
I'm looking at all these buttons and I'm not seeing one that says anything about chatting. No, I see pictures and shopping and reels, it's called, and searching and home. No, I don't see any buttons that mention it at all.
It's right like at the bottom of the Zoom screen. It's at least on our end, it's to the left of the share screen button. Directly to the left, it says chat.
Okay. Okay. All right, well, I don't see it, but that's all right. I wouldn't be involved in it anyway. But yeah, all right. Well, you guys can do whatever you want with that. I don't know anything about it now. Oh, you know what? Okay. Nope. No, sorry, I don't. I know squat about it. um, hmm. So you said when you said on the bottom of the screen, do you mean like the Zoom screen, or is that on Instagram on your phone?
Or Instagram on your phone, the chats are in the top right hand corner, I believe. There's a little bubble with a lightning bolt in it.
Really? Is that what that is? I thought that was the battery. No.
Not that top, not too far. Right below the battery is the chat button, I believe.
Okay, so now it does say new message. How do you like that? I guess I never noticed it before. Then there's a little video. Ooh, video chat too. Is that what you guys are trying to set up? Wow.
We just have text going right now.
Oh, so you're telling each other how much you love the class? um, so okay, well that's good.
Exactly.
I applaud your ambition. Um, I just look at pictures. That's all I do here. I don't know anything else about it. Um, but at least I'm that far ahead. I actually know how to put pictures on here. That's as far as I've ever gotten. And I can look at other people's pictures too. That I can do. That's about it though. And I also watch these little mini movies up here. What are these things called on the top? They only last for like 30 seconds or whatever it is, and then they disappear. Stories, that's what they are.
Yeah, stories I was about to say.
Uh, but the thing is, you can't actually like a story, can you? Why would they do that? Huh.
Yeah, I
This
don't
is,
know. It's like daily posts. I think they kind of borrowed it from Snapchat.
yeah. Where Snapchat, everything disappears in a hurry, doesn't it?
Yeah.
Wow, that is weird. If I'm going to take a nice picture, I want it to sit on here forever. I don't want it to ever disappear. So I guess that's why I'm not going to ever use Snapchat. That's for sure. Man. All right. Well, you know what? Every day, new mysteries are resolved for me about technology and other stuff. Um, all right. Well, there you go. Carry on with that. And so, in the meantime, we've got some fun videos today, which involve, of course, foreign exchange markets. There's one in here in particular that I would have shown it sooner if I'd known about it, but I only stumbled onto it the other day. And oh my God, what does that mean? What is his IG? Abbreviations are not my thing. IG, does that mean Instagram?
Yes.
Okay, but to say what is somebody's IG, what does that mean? Does that mean what is their official address there? Is that what it's called, by the way? That name that uniquely identifies you on Instagram?
Well,
What's it called?
it's just like a shorthand for Instagram. Like, what's your IG? Like, what's your Instagram?
Oh, I see. Okay.
Like, you'd say, what's your Snapchat, so to speak.
Oh, I got it. Okay. Okay. Well, enough of that for one day. You can explain this some of the stuff to me another time. Um, and you'll have to because I have to take advantage of I have a room, well, a group full of people who are young enough to understand the technology, and I certainly do not. So I may lean on you in the future for this stuff. Anyway, let me get back to yes, the list of videos. Let's start with that. So first I have to go find them. Hold on one second. And then they were both, of course, directly related to what we've been doing. They're excellent videos about the foreign exchange markets. But when we're done with that, we're going to get back to our discussion about hedging foreign exchange risk with derivative securities, which is an extremely important area of this course because, let's face it, a lot of corporations do business overseas, and foreign exchange risk is one of the biggest problems that they face. So the more they understand how to hedge their risks, the better off they'll be. All right. So there's a lot of securities that are available for them, but we just have to understand how they're used. So, all right. So we'll start with this one and we'll watch this for a while and then we'll go on to, I think I have one more for today and then we'll get back to our discussion about hedging foreign exchange risk. All right. So let me post this into the chat room. Okay. And then here we go. Let's check this out.
businesses are happy to take on risk, but they prefer to do it through these operations.
Okay. All right, let me know when you're ready. Okay, good. Yeah, so you can see that really would have made more sense to show that like last week, I guess, but well, I didn't have it at that time. But you can see they're trying to explain why so much trading takes place in these markets. But what we're going to do now, after we've considered that, and you can see why. I mean, with all the trade that takes place, obviously these markets will be massive, but there's more than just that. A lot of it comes down to investors shifting their funds around to find the highest rate of return for their dollars or whatever currency it happens to be. So a lot of those flows are not so much to finance trade, but to finance investments. And that's really where the majority of it comes from. All right, but now the next one that we'll be seeing is more related to what we've just been doing the last few days, which is foreign exchange risk and how to hedge it. Now, there's a lot of actually different ways of doing this. They don't all involve derivatives. We're focusing our attention right now on derivatives, but there really are other ways you could go about hedging your foreign exchange risk. Now, of course, you don't have to hedge your foreign exchange risk. It's not mandatory, but it's probably a good idea. In a lot of ways, it's almost like buying insurance. You know that it can be expensive, but if you don't buy it, you know that terrible things can happen. And so most corporations do tend to hedge their risks, even if it's not all of it, at least some of it, just to make sure that they don't have their profits wiped out by fluctuations in exchange rates. So this will give us an overview of the process of hedging foreign exchange risk. And when this one is done, then we can go back to our discussion about hedging risk with derivatives. In fact, if I remember, we left off with our discussion about options. All right, so first let's watch this, and then we'll get back to our discussion about options and foreign exchange hedging. All right, here we go. All right, let's check this out.
When a company does business internationally and buys or sells goods in a different country, purchases in the
All right, let me know when you're done. Okay, all right, we'll start up again in a second. I just have to do a couple of things here. All right, so I guess we'll get back to normal here. Resume share. All right, good. So we're going to get back to chapter 11, part 2. Now, I do want to point out, though, that I went ahead and I added something to this part 2. You can see there's now a presentation here called Chapter 11, Foreign Exchange Part 2 Updated. It's the same as part 2, but I've added a discussion at the end about, with specific examples about hedging foreign exchange risk with options. So you can see how that actually works. All right, so it somehow got chopped out of this one. So part 2 updated is what we'll be looking at right now, where at the end I've added some excellent examples, I think, of how this actually works in practice. But in the meantime, we were focusing our attention on understanding how options actually work in the first place. And then we can see specifically how they're used to hedge our foreign exchange risk. And of course, we also along the way will discuss how these, what are the advantages and disadvantages of doing this with options instead of forwards or futures. All right, so the previous section of chapter 11, we spent a lot of time looking at forward contracts and futures contracts. And so we already understand that they enable us to lock in the price at which we can buy or sell a currency in the future. And it's a very straightforward thing to do. And what's good about that is that there's no actual cost involved, but they're very rigid. In other words, once you lock yourself into a position, it's not necessarily easy to get out of it. Now, with options, it's the other way around. With an option, once you get into an options position, it's very easy to get out of it. But at the same time, though, it can be a very expensive thing to buy an option. So, you have to make your own mind up how much flexibility you need versus how much you're willing to pay for these options if you're hedging your risks with an option. All right, now let me just quickly remind you some of these key terms that we went over last time. First of all, with an option or any option, not just foreign exchange options, we need to specify several key details. For example, the underlying asset. What is it exactly that we have the right to buy or sell? All right. So, and that can be almost anything you could imagine. You can buy with options, you can take a position in interest rates or currencies, of course, equities, which are, by the way, just another name for stocks, equity indexes like the Dow Jones or the S&P 500, precious metals like gold, silver, platinum, and then finally, futures contracts. You can actually buy an option where the underlying asset is itself a futures contract, which gives you essentially a second level of complexity, because if you have an option on a futures contract, it simply means you have the right, but not the obligation to enter into a futures contract, which itself gives you the right to buy or sell some underlying security. So you're basically 2 steps removed now from the underlying asset when you buy an option on a futures contract. Now, it turns out at this point in time, many options that are trading in the marketplace are actually set up this way so that you're actually buying into the right to get into a futures contract rather than an obligation to buy the underlying asset directly. They're just more convenient in a lot of cases, and that's why they become very, very popular. They're more complicated, of course, but they provide us certain benefits that you won't get with an option that's written directly on the underlying asset. So just as an example, if I want to hedge my risk in British pounds, I can buy an option where the underlying asset is the British pound, or I can buy an option where the underlying asset is a futures contract written on the British pound. So they're 2 slightly different things, and each one is appropriate for different circumstances, as we'll see when we go along. All right, so either way, you're actually taking a position which enables you to hopefully hedge your foreign exchange risk or possibly speculate on the future direction of different currencies. Now, the strike price or exercise price is the price at which you are allowed to buy or sell the underlying security. Okay. This is what's locked in advance. This is why it's this price that gives the option its value, because this is the price that's established that enables you to lock in a price at which you can buy or sell something. Remember, the key detail is may. You're not required to do anything with an option. You have the right to buy or sell at this price, but never the obligation. And really, that's what you're paying for, the right to change your mind when you come right down to it. And this is something you don't see with a forward contract or a futures contract. What else? Oh, the maturity. Of course, the option doesn't last forever. It has a particular length until the date on which you either decide to use it to buy or sell the asset, or else you let it expire. Okay, so it has a fixed length of time until you have to make a decision. And the maturity date is almost always less than a year. In fact, it rarely goes beyond 180 days, although there are exceptions. And then finally, we also saw that the two basic types of options, the call options are the ones that give you the right to buy something, and the put options are the ones that give you the right to sell something. So just keep those in mind. Call means you have the right to buy. Put means you have the right to sell. So now, and I don't know where these names come from, actually. Maybe we could do a little research. Let's just see if we can find something here. Where did the names call and put come from? Who knows? Maybe somebody knows out there. No, but I was hoping that they would. No, all right. Anyway, it's not that important. Just remember, call means you have the right to buy. Put means you have the right to sell. Now, also, options can also be structured in two different ways. As you can see, these involve how much time you have to make a decision about what you want to do with your option. A European-style option means that you can only decide on the expiration date whether or not to exercise it. You get one shot at it, and that's it. The American-style option means that every single day, you can actually exercise your option if you choose to do so, right up until the maturity date. So clearly, the American-style option is much more valuable, but because of that, you have to expect to pay a higher price for it. So if you're going to be hedging with options, the American-style options could be very, very expensive because they give you more flexibility. Now, what about the price that you pay for your option? That's often referred to as the premium of the option. And this is a dollar amount that you have to pay for one of these options, whether it is a call or a put. And this is what really separates forwards and futures from options. With forward contracts, you're entering into an agreement. There is no price. With a futures contract or a currency swap, there's no money changing hands. The only thing we have to think about here is that the futures contract does require money to be put into a margin account, but that's just collateral. That is still the money that belongs to the investor. You're not actually paying for anything. It is simply a security deposit in effect. And so therefore, we can make this the case that forward contracts, futures contracts, and currency swaps do not require the payment of any money. They're basically just agreements, but they're binding agreements, which means that you can't realistically back out of them. Although it is with futures contracts, you can actually get around that by taking the opposite position if you do want to get out of your futures contract. In other words, if you own a long contract on British pounds that expires in March, well, then you can get out of it by taking a short futures position in the exact same contract so that the two contracts offset each other. But you're still in both contracts. In other words, they're still valid. They're still legally binding, but you can easily take a position in the opposite contract or an opposite position in the same contract, and therefore your net position is zero. So you're not really getting out of these positions. You're just using them to offset each other. Now, the option is expensive because it has the unique feature, which the others don't have, that the loss potential is limited, but the profit potential is unlimited. That sounds like a pretty sweet position to be in, doesn't it? The maximum loss and no maximum gain. Wow, that's a nice spot to be in. And this is, among other things, what you're really paying for with an option. Okay, so this is why they require the payment of a premium. The premium, by the way, goes into the pocket of the seller of the option, because for every buyer, there has to be a seller. And so what that means is that you are transferring the risks that you want to avoid to the seller of the option. And the price that you pay for the option is how they're compensated for taking on that risk. Okay, so if I'm trying to eliminate my exposure to the British pound, when I enter into an option contract, what I'm effectively doing is transferring that exposure to the seller of the option. So in exchange for that, the seller has to be paid. All right, otherwise they would never enter into a contract with us like this. All right, so we're going to start out by introducing the payoff to a call option. I think this is where we left off last time. What exactly is a payoff? All right, well, here's a formula, and let's explain what this means with an example. The max, first of all, max obviously means maximum. And so you've got two numbers in this formula. Whichever is the greater is the number that will be our payoff. And so this is the spot price of the asset that we're buying. And this X will be used to represent the strike price of the option. So what exactly does this mean? It basically means, first of all, the payoff, the way this is written, it may not be obvious, but the payoff cannot be negative. And we'll see how this works with an example, but it's written this way for a specific reason. It's trying to tell us that the payoff is the greater of these two terms. In other words, if S is greater than X, then the payoff is the difference between the two, which is greater than 0. All right. But on the other hand, if S is not, let's say it's less than or equal to X, the payoff is just 0. And that's what it really means. It's just a very compact way of saying that when S is above X, we have a positive payoff equal to the difference between the two. Otherwise, we have a 0 payoff. Wow, that's a lot to take in really quickly. So, but when we see a few examples, you'll start to say, oh, this makes perfect sense. So we're going to see some numerical examples as well as some graphs that will help us understand what this is trying to tell us. All right, so now, by the way, there's always terminology associated with any markets. Here, what we're going to do is make the following, we're going to define the following terms. If the payoff, if S is greater than X, this means that the payoff is positive. And we say that the option is in the money. All right, so in other words, if S is greater than X, we'll have a positive payoff. And we say that the option is in the money. It sounds like a nice place to be, in the money. Yes, well, of course, because that's what it is. It's a nice position to be in. What about if S is exactly equal to X? Then we say, now this means that the payoff is 0, by the way. And the option is said to be at the money. And then finally at the bottom, this S below X. Now the payoff can't be negative. So the payoff is still 0, but the option is said to be out of the money, in the sense that if we were so foolish to exercise the option, we would actually have a negative payoff. So let me modify this a little. The payoff is 0 if we do not exercise the option. Otherwise, it could actually be negative. So we're assuming that nobody will exercise the option when that would give them a negative payoff. And that's a pretty good assumption, I think. All right, very good. So let's look at a simple example. Now, this one is actually a stock, but that's okay. This options work the same way, no matter what the underlying asset is. All right, so here we're going to look at a simple example. The examples at the end of the chapter will be more foreign currency examples. But here, let's just take a look at a quick stock example. These are stock options now. We have a European call on IBM stock that expires on September 1st with a strike price of 50 and a premium of $3. So that means the option gives me the right to buy the IBM stock for $50 regardless of the market price of the stock. Now, I do want to point out that we must pay this premium whether we exercise the option or not. It's like any other insurance premium you might pay. Let's say you buy insurance for your car. If you never crash your car, the company doesn't give you your money back, do they? No, you pay that premium and that's it, because you're paying for protection. If you don't need the protection, then you're all set. It doesn't matter, I mean, but you're not getting your money back from the insurance company. All right, that's something to remember. All right, now, what we're going to do is set up a chart that shows all the different possible stock prices on September 1st, and we're going to show how to calculate the payoff for each one of those prices. And when we're done, we're going to show that relationship between the payoff and the stock price with a graph. It's a very interesting graph. So let's see how this works. All right, so here's, yes, the payoffs to this option are shown in the following table and diagram. So now, if you notice very carefully, this is just a bunch of different possible stock prices that we could see in September. And it ranges everywhere from well below the current price of 50 to above the current price. And so in the second column, we have the strike price, which never changes. And now if you notice, as long as S is less than X, that means the option is out of the money and the payoff is 0. Why is that? Because the investor will not exercise the option in these cases. Why would they? Because remember, the option gives you the right to buy the stock for $50. If the market price is less than 50, there's no point in using the option. So it has no value and it expires worthless. All right. So again, as long as the stock price is less than 50, there's no point in exercising the option. It is said to be out of the money and we will simply let it expire. Now here we got the case where they're exactly equal to each other. And the option here is said to be at the money. Now the payoff is zero here. You might exercise it for zero payoff and you might not bother. So it's possible the option will be exercised here, but there's really no point because you're just getting the right to buy something for $50, which is worth $50. So it's not very helpful to you. So you say the option is at the money and the payoff is also zero. Then the fun begins. In each of these cases, the stock price is above the strike, which means we do want to exercise the option. The option is said to be in the money. And you can see why, because they have the right to buy a stock for $50 that's worth more than $50. So of course they're going to exercise it. And then the payoff is now not zero anymore, it's positive. And in this first case, it's 55 minus 50. This one is 60 minus 50. 65 minus 50, 70 minus 50, and then finally 75 minus 50. So you can see the payoff keeps going up and up and up as long as the stock price is above 50. So if you were to try to draw a graph of that payoff column, it would have a very interesting look to it. What kind of look would it have? Well, let's find out in the next slide. All right, as long as I'm trying to make sure everyone's caught up. Then we're going to have a graph which represents the payoff as a function of S. And there it is. So what's going on here? The payoff is zero for every stock price from 50 down to whatever. So it's always zeros, but then all of a sudden, once we hit 50, and remember 50 is the strike price, once we get past that point, if you notice, each $1 increase in the stock price adds $1 to the payoff. That's from here on up. All right, so from this point on, Every time I add $1 to the stock price, I also add $1 to the payoff. So you can see that the slope here is equal to 1, whereas down here, the slope is equal to 0. And this is the payoff to my call option. So that graph tells me everything I need to know about the behavior of this option. The chart is helpful too, but I think it's easier to see what's going on with the graph. You know, it's so much nicer. Most of us are visual learners, and so seeing a graph, I think, is a lot more helpful than seeing a chart. Now, you also notice too, there's no negative payoffs in here. It can't go below 0, but there's no maximum payoff either. This thing can just go up and up and up forever, really. There's nothing to stop it from going through the sky. So yes, and this is, again, one of the nice things about options, this imbalance between maximum losses and unlimited gains. Now, this is all very well and good, but what is not here is any mention of how much we actually paid for this option. Okay, so remember from way back here, we said that this call is worth $3. And that means per share of IBM, by the way. I just want to mention this in passing. A typical stock option, which is what this is actually written on 100 shares of stock. Okay, so in other words, a call option would then be the right to buy 100 shares of the stock. So the total cost of doing this would be the cost per option times 100. Okay, so in practice, where here we're showing an option that only has the right to buy a single share. In practice, it's probably going to be 100 shares. And so what you're actually paying for is not the right to buy a single share, but 100 shares. So that means that in this case, since the premium is $3, the total cost of this option would be, and you would just put in 300, 3 times 100 equals $300. All right, so just be aware of that. In practice, but it's easier to show it with one stock at a time, but in reality is that you would probably end up having an option that's written on 100 shares. And the same thing will be true for currencies, depending on what exchange you buy it on. A currency option might give you the right to buy it anywhere from, like in the case of the British pound, anywhere from 10 to 30 or 60,000 pounds, depending on what exchange it is. So then all you would do is multiply those pounds by the price of the pound, and you'd figure out, or the price of the option, to figure out the actual total cost. Okay, now, what about the price? So we did come back here and note that it was $3. So what I need to do now is update my payoff profile, as it's called, to incorporate the cost of the option. And when I do that, what I'm actually doing now is calculating my actual profits and losses, which is different than the payoff. Because while the payoff has to be positive, or non-negative, I should say, the profit can be negative. It can be positive, 0, or negative. Okay, so the profit can actually be a loss once we formally take into account the cost of setting up this position. All right, so just be aware of that. But that being the case, losses are limited, as we'll see, to the price of the option. So the worst thing that can happen is you fail to use your option and then you end up just losing the premium that you paid for it. In a way that's just like with the insurance company again, where you pay so many dollars a year for insurance and you never use it. Well, I don't think you would actually call that a loss per se, but it is an expense that comes out of your pocket. All right, now how do we do that here? So we're going to show you the payoff profile or formula hasn't changed, but what we're going to do now is update it to reflect the premium or price of the option. So what you actually have here now is the profit or loss, which equals the payoff minus what you actually paid for that option. All right, so this is the payoff, this is the premium. So you can see why the profit or loss can be negative. Okay, so now we're going to need a new chart and a new graph. Of course we do. Oh, let me just leave that there for another second in case you're not caught up. The little C there will represent the premium of the call. In other words, the price you paid for it in the first place. And of course, you can't get that money back no matter what happens. Just like an insurance policy. All right, so what we're going to do here is take the same chart we had before, but we're adding a new column for C, the cost of the call option. And so now for the profit column, which I'm also adding, I'm taking my payoff and I'm subtracting the cost of the option, which is $3. So all the numbers in this last column equal the numbers in the third column minus $3. And if you look at this carefully, you'll see that the losses are capped at $3. And that's equal to the cost of the option. After that, there's no maximum profits, which is pretty nice. All right, now how do we show this graphically? Okay. Oh, actually, sorry, let me just let you carry on for a few minutes, and then I'll move on to the graph when you're all done. All right, so just remember, all we've done is added two new columns. One just represents the cost of the call or the premium, and then the last column is the profit, which is nothing but the payoff minus the call premium. And so for the first time, we have negative numbers. All right, I guess we're probably all ready. Now, if you look at this graph very carefully, you'll see that the shape is exactly the same. What's different is that it got shifted down by $3 because that's how much we paid for this thing. All right, so therefore, this whole region here could be interpreted to mean the maximum loss is $3, which is the cost of the call. That's as bad, that's the worst case outcome. You do not exercise the option and you end up losing what you paid for the option. That's it. Okay, now, if you notice here, here's the strike price. Now right here is an interesting new point. This is the so-called break-even point. Or break-even price. That means that if the price of the stock hits 53, I'll have a payoff of $3, but my the premium is also $3. So the difference between them, my profit is 0. And that's what we mean by breaking even. In other words, that's the point, that's the stock price where the premium and the payoff are exactly the same. Therefore, I end up breaking even. After that, from this point on, this is just all profit. And you'll notice there's no limit to the profit. Let's fix that. Okay, this can go up and up and up forever, basically. Okay, so the only separation here is that, or the only difference here is that the premium is taken into account. So this curve or graph is a little bit more realistic because it now shows us that we could, in principle, lose money if we do not exercise the option. But again, the losses are limited to my original investment, balance off against the maximum, no limit to the upside potential. You can see why options are a very attractive investment to many investors, and many of those are actually speculators. Okay, now what else do we know here? Options are highly leveraged, which we'll see later on when we look at more examples with currencies, which means that the rate of return is magnified compared with the underlying stock. So, in other words, while the maximum loss is 100%, on the upside, if you're not thinking about dollars but rates of return, you could earn a nice big rate of return for a relatively small change in the price of the stock. Okay, so for example, let's make one up real fast. Suppose the stock price rises to 60. The profit from the stock, or I should say the rate of return, so you would have the new price minus the original price over the original price, which is 10 over 50, which means you made 20%. The option, the new option price with a strike of 50. Now, it turns out this is not going to be an exact example because in practice, if the stock price goes to 60, the option price is likely to go up by more than $10. But let's just say the new option price is, instead of 3, well, actually, let's not think about it in terms of the option price. For the option, the payoff with a stock price of 60 is the max of S minus X and 0, which is the maximum of 60 minus 50, comma 0, which is 10. But remember, we paid $3 for this thing. So the rate of return equals the 10 minus the 3 you paid for it, divided by the 3 that you paid for it. And so you've got 7/3, which is 233%. Okay. So with the option, let's start with the stock, the rate of return is 20%. With the option, the rate of return is 233%. So there you go. Now, having said that, before you get all excited and go out and buy options, before you say that or think that, what if, on the other hand, what if the price, oh, actually, let me leave this there for another minute. So you can copy it. So the option gained because the stock price went up. So the payoff to the stock price is $10, but we did have to pay for the premium. So we actually earned $7 in profits based on an investment of $3. So we actually made 233% of our investment with a $10 price increase, which is only 20%. But on the other hand, what if the price had dropped? Dropped by $10. Okay, so the loss to the stock, or to the stockholder, I should say, would be, okay, so in other words, you would have 40 minus 50 over 50, which is minus 10 over 50, which is minus 20%. Now, for the owner of the option, oops. For the option holder, the loss equals $3. 0 minus 3 over 3 is minus 3/3 equals minus 100%. Okay, so in other words, when we made money, a $10 increase gave us a rate of return of 233% instead of 20. So that's good. But on the downside, instead of losing 20% like the stockholder, the option holder loses 100%. The entire value of the option is wiped out. So they lost what they invested. So you can see either way, the option is more heavily leveraged in the sense that it's much riskier. There's a much bigger swing between gains and losses for the same change in the stock price. Wow, that's a big difference. All right, in the upside, 233% versus 20. On the downside, minus 100% versus minus 20. So that's why we say that options are highly leveraged. And that's why, though, they're so popular for speculators, because if you guess right, you can make tons of money in a very short periods of time with an option, but you could also lose your shirt very quickly just as easily. So therefore, for people who are in this business, who are in this market, they must know that they're taking a lot of risks when they buy options, but the upside potential is enormous. And again, the worst thing that can ever happen to you is you lose 100% of what you started out with. And some people would say that's not a bad gamble. Okay, so but obviously you don't want to get involved in the market like this unless you really understand what's going on with these prices. Now, by the way, I do want to mention here that with a call option, you buy a call option because you believe the price will rise. I'll add an extra section here. A hedger buys a call option because he or she needs protection from a rising price. All right, so in other words, the option can act like an insurance policy where if the price does go up, you'll get a payoff from the option that helps offset your higher expenses. So in a lot of ways, the call option could be construed as a type of insurance policy. All right, because what you can do, and we're going to see a lot of intensive examples of this at the end of the section, where investors or speculators can make money with currencies but we have to choose carefully what position we take, depending on what we're concerned about, whether we're concerned about rising or falling exchange rates. All right. Now, what about the puts? Those were the calls. We know that when the price of the stock goes up, the call will benefit from that, and so will the owners of the call option. The put is the opposite case. The put is used for cases when you're very pessimistic about a stock, or any other asset for that matter. When you really think the price is heading down, you can take a position in which you'll make money if you buy a put option. All right, because remember, the put option gives you the right to sell the asset. And so this means you'll make money when the price of the asset falls. So suppose you think that for whatever reason, Tesla will have a rough year this year. You can make money, if you're right, by buying a put on Tesla stock. Now, before options came along, it wasn't really that easy to bet against a stock. It was kind of awkward. The existence of options provides investors a lot more opportunities to either place bets or to hedge their risks. So the options markets, once they started to catch on and people began to understand what they're all about, the volume of trading grew massively. In fact, maybe we can get onto Google and find a chart that shows us how quickly let's try that. Okay. Oh, no, you have to pay for this one. No, you know what? Oh, boy. No, maybe not. Let's see. Index volume. Boy, I don't know. All right, let's try. They've got some kind of an index that they've put together here where you're allowed to look at the trading that took place. No, see, I don't know. Let's hit the agree button. Oh, but this only goes back a few years. Yeah, I was hoping to do something better than that. Like back, we're going to see, by the way, I think later on, we're going to see that in the United States, at least, the first options became available in 1973. And so since then, let's see what we can do about. Let's just focus on equity options. Maybe not. All right, I'll look around for that. But let's just say that the volume is big right now. It started out tiny, and then when people began to understand how important these were, that's when the volume really started to take off. So, but in the meantime, let's focus our attention on these put options, which are the ones that give you the right to sell the asset. And so the purpose here is to buy them if you think the price is going down, or possibly to hedge the risk that the price will go down. Either way, you'll make money if the asset price goes down. Now, if you recall, the payoff to the call was, let's see. This is our put payoff. And you can see it's different in a very important way. I've switched the S and the X. So you can see this increases when S decreases. Because this difference, this is a constant. So if I continue to shrink S, this number gets larger. Whereas up here, this increases when S increases. Because obviously X is a fixed constant. If S goes up, then the difference between them goes up. All right, very good. So the payoff to the put is essentially the reverse of the payoff to a call, because this is the one where we have the right to sell something and we're going to benefit when the price goes down. All right, now the profit or loss, as you can probably guess, is constructed by taking the payoff and then we subtract the put premium, or the price that we paid for the option. All right, and this part is exactly the same as we had for the call. Okay, so this is the call up here. This is the call profit or loss. All right, and down here we have the put profit or loss. Okay, so you can probably guess that the graph for the put is going to look very different. Now, since we're running desperately short on time here, I'll tell you what I'm going to do. Why don't I jump ahead and show you the picture real fast, and then we'll come back and revisit this on Thursday. So this is what the payoffs look like to the put, whereas remember with the call, it was going the other way. Okay, so this is supposed to be the payoff to the put of the call. Very poorly drawn, but you get the idea. This is the put, and if we could see them side by side, you'd see that they are mirror images of each other. Okay, because they're moving in opposite directions, they react differently to changes in the price of the stock or other asset. Okay. All right, now we don't want to rush through this part too fast. What's coming up is, fairly complicated. We want to go through a thorough analysis of how puts work, and then we're going to have to look at the perspective of the sellers before we can get to our first examples of how we can use calls and puts to hedge our foreign exchange risk. Okay, so why don't we hang on to that until Thursday, and we'll pick it up where we left off right here. Okay, so unless there's any last minute questions, I think this is as good a time as any to stop, and we'll focus on this again on Thursday. All right. All right, see you next time.
Enjoy your week.
All right, you too.
Yeah.
Okay, bye.
Bye, Professor.
See you later.
Professor, I have a question.
Yes, go ahead.
When's the midterm or the next test?
Oh, well, it's going to be a take-home midterm.
Mm-hmm.
And not just yet, maybe not next week. We'll see. But when it does arrive, I have to go back and remind myself which chapters it covers. Before we do anything, we have to go through a bunch of reviewing. We're going to have a bunch of problem sets that
Okay.
we put together, and then I'll give it to you. And you'll have plenty of time to finish it, and it will be exactly like what we're doing in the class.
All right. Thank you.
Okay, you're welcome.